Define equity and gain. Equity and gain are both important to an exchange, but they are never the same number. Let's take a cursory look at how you determine both equity and gain, shall we? First, equity represents the hard-earned value that is yours in any property you own. So, if you take your gross selling price and subtract your closing expenses or closing costs, and then further subtract the amount of any debt, that remaining amount which is left over will be your equity. Now, how about capital gain? Well, in order to determine gain, we need to know what is called your cost basis. And your cost basis will be informed by when you bought the property. Let me explain. When you originally bought the property, you had a purchase price, correct? Well, that will be the start of calculating your cost basis, which actually changes over time. For instance, if you've done any improvements on the property, that amount should be added. And likewise, if you've deducted any depreciation while you've owned the property, that will be subtracted. Therefore, let's determine your cost basis and gain this way. Let's find out what's called your adjusted basis. That will be our original purchase price, plus any improvements, then less any depreciation. And that gives us our adjusted basis. Now let's once again take that net selling price from our sale, deduct our cost basis, and bingo, that's our capital gain. The number which you would pay gain tax if you did not exchange. And one last thing. Here's a very simple rule that works in exchange if you want to have a totally tax-deferred transaction. Accomplish these three things, and your exchange should be tax-free. Number 1, buy a replacement property that is equal or greater in value than your net selling price. And 2, move all your equity from the old property into the new one. And lastly, replace your debt. If you do those three things, your transaction should be completely tax-deferred.